I am going to show a bunch of research. Everything I do is based on historical research, a quantification, if you will, of an idea. If I can't prove that the idea has made money, then I don't trade. So I'm going to share some of that research today at a very high level. Do use this information at your own risk. Past is not a perfect predictor of the future or necessarily indicative of future results, but it's the best information we have and can be quite valuable, as I've made my trading career based on using historical information. If you want to copy these slides, go to investorquant.com/Festival of Traders. investorquant.com/Festival of Traders. I've got an ebook that sells for about $30. I sold 5,000 copies about 6 or 7 years ago. We updated it. I just updated it end of this year. So you can get a copy of the slides and the free ebook, and I'll just push that to you there in the chat box. And that's the only pitch I've got today for you. So sit back, relax. I'm not going to ask you to buy anything. I know a lot of people like to use this time to educate and then try to give you an offer at the end, and I appreciate Dave giving us that chance to do that. Not really my style. What I'm going to show you is hopefully going to help you be a better trader regardless of your trading style. It'll resonate particularly well with some of you that are interested in numbers and quantitative concepts. That's what I do and what I've been successful doing. And if so, you'll check us out at InvestorQuant. If not, hopefully you'll be a better trader. And yep, there you can get the ebook downloaded as well. As I mentioned at the same link, investorquant.com, Festival of Traders. So I'm going to show you one super quick thing about my resume, actually the only thing that matters whatsoever. Then we jump right into my favorite opening trade strategy is around the opening gap, as it is for many people, though there are many traders that don't like to trade the opening gap. Some people call it amateur hour, or some people say it's too dangerous, too risky. It is a little bit of amateur hour. That's what makes it so good if you know what you're doing. So I'm going to talk about that, share some gap trading statistics, and really explain my methodology. So even if you're not interested or decide not to trade the opening gap, what I do can be very helpful for any trader of any time frame. It's sort of a homegrown approach that works for me. It's actually rooted in hardcore statistical analysis, predictive analytics, and it works on anything. I'll use the gap, my bread and butter, to sort of demonstrate the idea. And I'll show you how you can learn more. In fact, I've already showed you how you can learn more. Just go to investorquant.com/Festival of Traders. So I have a decent resume. I'm not the smartest guy. I'm not the most experienced guy. There are a lot of things I'm not, though I am pretty tenacious. That's one trait that everyone has to have. But here's the key thing. You don't have to have a resume that has anything that looks like this. And I was fortunate to take a company public in the 90s, in my early 30s, actually, as a young man. A little older now. It's been about 20 years. But none of this really matters. In fact, some of this is a little tongue-in-cheek, right? A lot of people like to show off the resumes. This honestly doesn't tell you one thing about my ability to teach you how to make money in the markets. A lot of people have more impressive resumes, and that's the only point I want to make here. The only thing that matters is can they point to real-life trades. The more the better, and actually show some historical results with them. So this is every trade I've taken, with the exception of a $40,000 account, I turned into a $20,000 account, practicing and experimenting with some various strategies. That was through a different broker. But every other trade I've taken in the past, 9 years, everything I'm going to talk about today is included in the data here. These are 90% of these trades, and there's over 2,000 of them, are opening gap trades. So I've been doing this a long time. And the key thing here is not the fact I've made some money, or how much, because it doesn't even show you that. It's the fact that I have endured all these little dips right here. These are called drawdowns. These are pullbacks in the equity of your account. This is the hardest thing to survive as a trader. I have doubled accounts during this time in less than a year. I can tell you, though, in retrospect, I traded too aggressively. And knowing what I know now, you're at great risk of ruin if you try to too aggressively trade an account, even if it's a small one. you may not destroy yourself financially, but you could destroy yourself psychologically. So bottom line is I've made a bunch of mistakes. I've managed to survive them, and I'm going to show you how I've done it over the years. So let's get into the gap trade. And what is a gap? Well, it's real simply, and you can define it different ways, the difference between where a market opens versus where it closed on the prior day. You can define the opening price however you want. I use 9:30 a.m. Eastern Time, which coincides with the open of the Chicago Merc. And the closing price I use 4:15, which is 3:15 Central, 4:15 Eastern, which is again the closing of the pit sessions there in Chicago. The bottom line is I basically mimic. I'm trading futures, and I'm mimicking the time frame where most of the volumes occur here in the U.S., and that's when the New York Stock Exchange is open. So that shows up visually on a chart. This is what it looks like. 5-minute chart. I like to use 5-minute charts, but on daily charts, they can look like this as well, actually. But this is a 5-minute chart. You close at one level. So this example, 1978. The next morning, you open at 1971. That's down about 7 points in the ES, or equivalent to roughly, say, 70 cents in the SPDR if you're trading ETFs. And this particular day, the price action was pretty volatile both directions before ultimately retracing back to the prior close, filling the gap. It is this move that I like to take advantage of or try to capture. Hopefully a little smoother than this. That's called an opening gap, and I like to fade it, meaning I like to trade in the opposite direction of the prevailing move. If the gap is up, I short it. If the gap is down, I buy it. Now, why would I do that? Because big money doesn't like to chase the low volume amateur moves that often drive price action pre-market. If anything, it may be legitimate news. It may be monthly jobs report, but if anything, they're going to trade the opposite direction, try to keep things under control until they can reverse it later. And that's the way I think about it, and that sets up an opportunity for me as a retail trader to piggyback on what big money is doing, because they leave their footprints all over the web, and that's what I've identified in my analysis that I'm going to show you. So this would be the ideal opening gap fade. Price gaps way down, go long, get out around the prior day close. That's called a gap fill. That's a beautiful gap fade trade. So that's a gap fade. That's what we want. Unfortunately, they don't all look like that, but that's what we're shooting to identify and trade. So the reason they work, it's important to understand this isn't just something I've made up. There's a number of events that cause the futures markets to move overnight, and they happen on low volume. 90% of those are large enough to trade, and 2/3 of them are going to fill that very same day. So that's driven in general by these emotional news-driven traders that react after, say, 8:30 a.m. Eastern Time news. But regardless of the cause, they tend to revert back to the prior day close because the big money is not going to chase. So let me show you some stats. And by the way, if you're just joining us, you can download these, copy these slides at investorquant.com/festival of traders. I have lots of research here. You don't have to track it all. Just go there. I've also got my ebook, which we normally charge for, but I give it away. In fact, I know we've only got a little bit of time, and this is going to be a bit confusing perhaps for some of you, or just a different way of thinking about the markets probabilistically, right? I'm not going to show you a whole lot of charts. My book that I'm giving away does tell a nice comprehensive story about how these pieces and how this disparate data all fits together to help drive my decision making. So check it out. Got a lot of great reviews over the years on it. Anyhow, what you can't see looking back year over year since 2006, 200 to say 240 tradable gaps in a given year. Average win rate's 68%, and it bounces around plus or minus 3 or 4 percentage points around that 68%. So remarkably consistent. So I like to think of it as an inherent bias, an edge I've got right out the chute when I start my trading day. And it's not just a directional edge, it's a psychological edge, right? I mean, this game that we play called trading is harder psychologically than it really is financially. It doesn't take rocket science to not blow up your account, though you can be led down a path that may make you want to trade too aggressively. That's certainly not my style. But you have to preserve financial capital and emotional capital. to be successful, because the way to make the most money in the markets, think about this, because I think there are too many people that teach you otherwise in this space. I have a problem with that. But that's why you're going to hear everything I show you is fairly conservative. The way to make the most money over the long term trading the markets is to stay in the markets, trading them for the long term. So don't blow up your account. Don't trade too aggressively and get kicked out in year one because you can't handle it. You can't handle any more losses, or psychologically you're ruined. Don't do that to yourself. This is a tremendous opportunity for every one of you to achieve exceptional returns, to achieve your financial goals, all within your own fingertips, using your brain, and it's an incredibly powerful feeling to have that autonomy. But you have to stay in the game long term. You have to take a long-term approach to this. Don't judge your results day in or week in or month in and month out, or even year in and year out. That's hard to do. If you're trying to make income, it's a high-pressure cooker. You better have a large account to deal with it. Better way to do it is try to supplement your income using trading if you want. Take a long-term view. But I digress. Let me continue. Stop and target placement. So if most of the gaps fill the same day, then you just want to trade them all, right? Unfortunately not. It's not that easy. So what's the optimal place to get out? If you're fading the gap, if you're buying a down gap or shorting an up gap, what's the optimal target? Well, I've looked at it many different ways, and I can tell you the optimal target is gap fill, which would be 100% of gap size. That's what this shows. Or beyond. Why? Because the win rates stop, they slow down. They don't degrade as much as they do in the first part. So meaning you can still get the overwhelming majority of your gains at gap fill and then some without giving up a whole lot of win rate. A real common mistake that a lot of educators teach and a lot of traders do is that they like to target the midway point because it's 85% of the has an 85% has about an 80% win rate, which means that sounds great, but for just a little degradation in win rate from 78 down to 68, you can double your average win size. I'll say that again. A little bit of reduction in win rate. You can go from a 78% win rate targeting gap fill targeting the midpoint of gap fill. Give up a little bit of win rate, accept a lower win rate, and double your average gain. Mathematically, that is off the chart advantageous for you to do. Yet most traders don't do that. So 85% of them will go all the way if they've gotten halfway. So at least consider holding on to a piece of the position. That's a giant trading tip for you that will make you some money. So what do you do next? Well, you just trade them all and just exit if it doesn't fill the gap? Nope, because you won't make any money, right? So you have to have a reasonable stop to protect yourself in the event the gap doesn't fill, if it's at 1 out of 3 that doesn't fill, and then reverses and goes the other way. Some of those will turn into giant trend days. You don't want to get caught on the wrong side of those. In fact, that's what this chart shows, that no matter what size stop you use, whether you use an end-of-day exit or some giant stop, you're not going to make any money. See, profit factor 0.99, 1.06, 0.99. Profit factor is a ratio of historical profits to losses. So if it's profit factor 1, it's dead break even. It means you haven't made any money. And what do you see across the board here? Profit factors that are basically break even or maybe slightly positive. But by the time you account for commissions and slippage and execution errors and mistakes, you haven't made any money. So you can't trade them all. And unfortunately, stop size is not going to solve the problem on how do you make money trading gaps. They have an inherent bias, but obviously I haven't told you how to make money trading. I'm trying to show you what doesn't work, because the natural inclination is to try to fix it with stops, or to try to ride it further, or try to do some judgment on the fly, reading charts like the Ouija board. So don't suggest you do that. Not many people can read charts dynamically, real time, with a live market, and consistently beat the markets year in and year out. Plenty can do it for a few days, a few weeks, a few months in a row. Few can do it an entire year, and even fewer can do it over the time frame, the only time frame that matters, which is year in and year out. So I know a lot of these other educators are big believers in charts. Well, I just ask you to ask them to see their results and show you their historical results of all their trades year in and year out. If they can't show that to you, I'd be very careful. All right, So stops and targets, you got to use a stop because you don't have a chance of making money. The 30% stop won't make you money in its own right, but for me, what it does is allow me to have a high enough win rate to stay in the game. So if you go back and look at this 30%, this is average true range. You can look up average true range if you want. It's a great simple way of measuring volatility in the markets. Use 30% of the difference between the high and the low. You're going to have at least a 55% win rate. If you're selective, you're going to get, this could be even higher. So I'm generally shooting for a 60% win rate or higher. 40% is a good stop to use as well. So that some people say that's a large stop, and my argument would be, well, use a smaller stop if you want. Get stopped out more. So it's just the stops just give you they directly impact your win rate. They don't directly impact your profitability. So the name of the game, how do you make money, Scott, is selection. You have to be selective. As I like to say, you can't nor should even try to kiss all the pretty girls or pretty boys if you're a lady. So what are some good selection criteria? Well, gap size is a great one. It's fundamental to me. Gap direction and size they go hand in hand. And you can see that the smaller gaps, if they're less than 40% of the 5-day ATR, say 50 cents or smaller in a SPDR ETF, less than 5 or 6 points on average. That's a loose average. With the current prices, you can actually trade 7. That's more like a 7 or 8 points. But just trade the smaller gaps. Don't trade the big gaps and try to fade them. The bigger ones, as this data shows here, have low win rates and actually lose money. So if you lose money in one direction, maybe you consider switching directions. Go with those gaps. Follow those gaps. So the common gaps are the smaller ones. They have the highest win rates, and they're actually also the most naturally profitable for trading, or fading, as I like to say. Day of weeks is another great selection criteria. By the way, all these stats are based on 10 years of data in the S&P futures. So historically, shorting up gaps on Mondays and Tuesdays have been the most problematic. Today, the small gaps filled, but again, they were small. So you had a Tuesday risk factor, but tiny gaps up. They all filled except for the NASDAQ, actually, NASDAQ futures. Buying down gaps in the middle of the week generally been a good thing. I think that is impacted a little bit by the long bias of the past 10 years. But in general, it's a data point. I don't make any trades. I don't select any gap to trade based upon a single data point. So I like to look at gap size, direction. I use zones, which are in my book. You can read about those. The opening gap zone. There are 10 of them. Incredibly valuable to use. And I look at all of that, size, zone, direction, day of week, in the broad context of the current market conditions. Right? Because, believe it or not, everything I just told you, those numbers were averages for the past 10 years. But the numbers for that average varies wildly depending upon the market conditions at the time that the gap was occurring. So it's all about market conditions. Market conditions are not the only thing. It's not everything. It's the only thing. Really, when you get down to it, it's all about context of your setup or your strategy. So I don't have time to get into these, and frankly, it wouldn't be all that helpful for you, even if I told you exactly how I calculated trend, momentum, volatility, ever bought, ever sold, and seasonality. It just wouldn't. I have a pretty good way of doing it, and what I've figured out is I don't necessarily have the best trend system or the best momentum system or volatility system. What I do have are systems that work really well together. That's the key. So don't stress too much on whether or not you know the optimal way to create a system or identify market conditions or what state you may be in. The key really here is to look at market conditions several different ways, because nothing defines the state of a market by itself. All of these individually do a good job of defining a portion of the market environment, but collectively they do a fantastic job of defining the market, even though they're not necessarily comprehensive and they don't consider every single angle that you may want to consider. For example, you don't see volume anywhere up there. I've traded for 13 years now without ever using volume as a decision factor. Now, does that make volume bad? Nope. Is volume important? It can be. It's not to me. I find historical data volume not reliable, so I don't trust volume-based strategies as much. That's why. That's the only reason. The key here is come up with your own criteria. Look at every setup you're doing, whether you're trading the gap or not, through multiple lenses. That's going to give you the greatest long-term results. So here's an example. Don't believe me that market conditions are important? Here's a real simple concept. What if you were to fade all large up gaps? Just picking one scenario. Get a large up gap, we might get one tomorrow, who knows? And you shorted it at the open, over the past 15 years. And the only other difference between the two scenarios was you followed a 10-day high or you followed a 10-day low. Well, if you get a large up gap since 2000 and it had closed the prior day at the highest point of the prior 10 days, so we've been rallying for 10 days and this was the highest point, it's been actually a pretty good trade opportunity. It's only 55% win rate, but it's made a profit factor of 1.3. It's made 30% more profits than losses. What if we're at 10-day low? Yuck, 40% win rate. That's a huge difference. That's almost a 50% difference. Well, it depends on how you do the math, but it's much lower, right? And you would have lost a bunch of money. So market condition, this is an overly simple example, but I'm just trying to make the point. Market conditions really, really matter. So what I've evolved to over the years, when you download my book, it's not going to show you anything here. This is a screenshot of what I look at every day. It's all of my systems summarized and averaged up here for each different size, different direction, and so on. This is from early in the year, and the S&P showed historical odds for shorting small up gaps, fading small up gaps, 5 systems, 4 more positive, very attractive, very profitable historically. 1 was neutral to slightly attractive. Needed a 7.5 point stop. And it didn't matter if the gap were 2 points or 10 points. The math holds up. This is ultimately a math game. So this was a no-brainer for me. I took it, traded, and I would do it every single time, even though 1 out of 3 doesn't work. So what I just showed you is essentially what we call ensemble forecasting, taking multiple ideas, multiple concepts, multiple systems, and analyzing how they've done historically under similar conditions, and then averaging them up. And when you have the average of multiple systems confirming that historically it's been a good setup, then you are taking a trade that has a positive trade expectancy. And that's what this is really all about. Too many traders are trading based on charts, in my humble and highly biased opinion, without any real knowledge of whether or not they're trading something that has a historical edge. Maybe someone told them, maybe their best friend, maybe their wife, maybe some educator they spent a bunch of money with. Surely the educator couldn't be wrong. Well, if they can't prove, and you can't prove to yourself that there's a historical edge, then what in the world are you doing? So I only trade when there's a positive expectancy, and I use this process of predictive analytics called ensemble forecasting. I didn't make it up. It's been around a long time, decades and decades. Created by people a lot smarter than myself. So this works. This just isn't theory. Trading 1 contract only across a number of my gap strategies. I have 8 of them. This is a $100,000 account, but don't worry about that. It's just I would trade it more aggressively if it wasn't a tracking account. And I was just trying to keep a simple 1 account, up 14% for the year. Easily could be up 2-3 times that and not have taken a significant drawdown during that time.